your BBC thing. Anyway, go ahead.
Well, you know,
yeah, it's fun.
Of course.
Okay.
Always love it. I'm a media hound, you know.
All right, we have a special guest with us today, everybody, here for our TradeGate Hub community, and we have Danny Blanchflower, who's a labor economist. Welcome to TradeGate Hub, Danny. I'd like to read something. Bear with me, and I'd like to read something for your introduction. And it was a quote from the Telegraph UK, and it talks about Princeton University's Richard Lester Prize for most outstanding book in industrial relations, and you were the Business of the Year by the Daily Telegraph and their Great Britons of 2008. And this is why, Danny. And I know you don't bring it up much because you're humble, but the quote says, yeah, you know, you're humble at times, and it says, not only did Danny Blanchflower foresee the scale of the recession months before the eventual impact, he attempted to do something about it. He was the one Bank of England executive who consistently argued in favor of dramatically lower interest rates. He was the first policymaker from the Bank, Treasury, or Financial Services Authority to warn that the UK faced recession and the possibility of house prices falling by a third. Blanchflower has decided against taking up a second 3-year term on the MPC. The Bank of England will be the weaker for his absence. Why did you decide, Danny, not to go for another term at the BOE?
Well, a practical reason. I have an endowed chair at Dartmouth, and they gave me 3 years leave, and I wasn't going to give that up for such a low-paying job.
Okay.
But the other thing was, it was absolutely awful. It was a completely awful experience. I was in a minority of one from October 2007 through really till about September 2008. And my daughter said, Daddy, you went from being a goat to a guru.
Yeah.
But for being 10 in a year being a goat wasn't really very simple. I felt it was a tough time. And I think the other one is if you've got what they said, it was time to get out, because only downhill from there. But I think the answer was practically it was a very tough time. I mean, I remember going there and being told that central banking is boring. It has not been boring. It was not boring then, and it certainly isn't boring now because of the complexities of what's gone on. So, but the answer was, in a sense, my background and experience was actually pretty helpful. I studied cross-country comparisons. I studied labor markets. I studied shocks to systems. And it turned out, and I actually studied happiness too. But that background and experience turned out to be pretty darn good, because I saw a huge shock hit the United States, particularly in financial markets and housing markets, and spread around the world. So being a data guy was good, but it was time to move on to pastures new, back to being an endowed professor.
Well, you know, I thought of you prior to the NFP coming out in the States last Friday. I had scheduled you to come in and talk about it. I had no idea what the number was going to be, and you know, the surprise it would be on the downside, since, you know, a lot of the government support programs are rolling off. You would think that people would be forced to re-enter the labor force, and there's plenty of jobs available. We're hearing about labor shortages everywhere, and yet the numbers aren't coming in for people going back to work. What do you think the reasons are? Is it that people are still COVID scarred? They have PTSD. They got used to government support. They don't want to go back to what was their life prior to COVID and are looking for something else. Where's the disconnect?
That's a great answer. Obviously, COVID has had a big impact on people. People are still concerned and scared, especially in southern states, about, you know, what's coming. The other thing is that the nature of the vacancies. We saw the JOLT surveys yesterday, the 11 million number, and jobs not being filled. But, you know, the story of mismatch is that these are jobs. The vacancies are in San Francisco and the workers are in Tennessee. So the first thing is locationally, they're in different places. Second, they're in different occupations and skills. Third, some of those occupations are less attractive today than they were in the past. So think about, nursing jobs and hospital jobs and care home jobs. So that's the first thing. The second thing is, I do think that people have lost sight of the fact that large numbers of people are actually reported, about 5 million people, more than we would have thought, have reported they're going to retire. I mean, in some sense, what you might think here is that people have now put a higher value on their leisure time. Let's use the word leisure. I mean, it's, let's perhaps think of it as COVID safe time. They think, well, I can go work for whatever the amount is and expose myself to a COVID shock, or I could retire. In the 2008 recession, we saw people putting off retirements. But given, the balance of risk between going to work and catching COVID and staying home and retiring, so there's that balance that's going on. The other thing is that these are adjustment shocks. So we don't know, for example, are these jobs actually full-time jobs? Are they being offered, are you being offered a job? The job on JOLTS is a 12-hour-a-week job. You don't want to take that. You say, it's not really a job. I can't live on 12 hours a week. So I think this is about an adjustment path of an economy. The best way to think of it is, think of a tsunami or an earthquake or something hits a place, and the economy has to adjust and find
shocks.
And that's the right way. That's the right way. The analogy I've been thinking about actually is really interesting. Is I've been reading this book called Bubbles in the Sun, and it was by Christopher Knowlton, and it was about the fact that the great crash actually started in the Florida housing market, which has started to slow by 2006, and then it got hit by a giant hurricane. And the giant hurricane basically wiped stuff out. People defaulted on their loans. Banks were weak, but it was the shock that hit and had long implications. So this people talk about long COVID, but for a labor economist, this is long response to COVID. And these are adjustments. And so part of it is that what you've said is right, but also it takes a while for these adjustments to take place. And if firms think they have these vacancies there, then they're going to have to raise the wage. And we haven't really,
how about and they're doing that. Wages are coming up. How about a lot of people got used to telecommuting, and I know I'm grateful that I don't have to spend 3 hours going back and forth to an office, and I could just decide which bathrobe I'm going to wear at work, right?
I realized for about a 2-year period, I don't think I ever wore anything other than flip-flops.
So
and I'm starting teaching, face-to-face teaching on Monday.
Okay. What's the university again, Danny?
I'm at Dartmouth. So what happens at Dartmouth is there's compulsory vaccination, in class wearing of masks. I think we're at 93% vaccinated.
Okay.
So we're going to see how it goes, but and in New Hampshire and Vermont around us, the case Vermont I think is number 1 and New Hampshire's like number 4 or something. So we haven't got much community spread, but there are still, even here there are still lots of places. The pizza places just still does takeout. Lots of the places are still closed. This is an economy that adjusts. And I think we should go back to what long-run changes in behavior are there going to be? Okay, people are still telecommuting. Maybe they'll do that forever. But what, in the end, will people go back to the cinemas? Will they go back to the gym? Will they go back and commute? And my suspicion is they're not going to commute anymore. I think they realize the value of, I was talking to a journalist yesterday who actually lived in London, worked in London. And in fact, in the last 3 months, he's moved to Brighton. I was born in Brighton. Brighton's a classic commuter town. People would get on the train, drive for an hour into London. They're not going to commute. They're going to live in Brighton. They're not going to commute. He's not going to get on the train ever again. So these changes are going to take a while to occur. But my view is that the data is hard to understand, and much is still to happen, and all the risks are to the downside.
Yeah, and I've read, Danny, that a lot of people were saying, well, I even brought up, people don't want to go back to work. They're making more money with government support. But yet there were many states here in the U.S. that ended the programs early. And I read the response wasn't a push to go back to work, that all that really occurred was consumers pulled in their horns.
Well, it wasn't just that. It was that those people had less money to spend, so they spent less money. And
Right.
so there was no evidence of any employment effects, but there was just down effects on the economy. So these simple things are not going to really work. I mean, we've seen in the UK, there's about 1.5 million workers still furloughed. They're taking off the furlough help. They raised taxes yesterday. And just as the governor of the Bank of England an hour ago said, oh, now we appear to see the economy slowing again. Oh, okay. So obviously the other thing which we need to be mindful of is, and what's happened over the past day, is people say we're going to pull the stimulus off. Lockdowns are all over. And then a new wave comes and you go back to lockdown again. So
you
obviously
think that could happen? People don't think that could happen in the US again. I mean, people are adamant about that. We'll never see another lockdown.
Well, it depends. I mean, we may state by state, we're certainly seeing it, aren't we? We're seeing it. Think of Florida. The courts have gone and said you can't impose these lockdowns. School districts oppose it. I mean, in places it maybe you're right, there will not be a national lockdown, but this wave from Delta knocked people sideways. Think about if we were talking in June. I listened to a nurse say in July we could see the light at the tunnel.
Right.
And Delta came down the tunnel and blocked the light out.
Yeah, and the draconian measures in a country like Australia that comparatively with cases have very little COVID, and I think they've been locked down for 6 months already.
Well, New Zealand is really the one, but they have a problem. A friend of mine, one of my colleagues, has got his kids in New Zealand, and the question is, can he go to New Zealand to visit them, and can they leave New Zealand to visit us? Well, they haven't really got much COVID, but they're not vaccinated. They haven't had COVID spreading, right? But they're now in a position that they don't want people coming into the country, so they're now having to reevaluate. Yeah, we haven't got any COVID, but we haven't got immunity to COVID, and now we're going to have a campaign to vaccinate people, and the economy is basically still locked down. So obviously these are not simple choices, but I think as a labor economist, this is about an economy adjusting to a shock that we've never seen before. We've never seen a shock with the speed and the depth. So remember, unemployment in the US was 3.5% in February, and it was 20% in April. So we, in the Great Depression, we saw a rise in but we never saw it come up for 6 weeks.
Right. Yeah, it's an amazing speed of cycles, almost like we had in 6 weeks what normally would have taken 2-3 years of economic
and the other thing,
recession.
Dale, I've spent a lot of time trying to think about what happened to other countries. And other countries have not seen this giant spike in the unemployment rate. And it's not to say that they haven't had the effects, but the countries like Germany and the UK and France and elsewhere, they had policies in place to prevent a rise in the unemployment rate. It's not to say that their shock wasn't any greater. It's just they did not get this giant labor market response. They had millions of people who went onto furlough schemes who are not working, but they don't count as unemployed. So obviously there's a pretty big difference. I mean, I look at data in Scotland. I mean, I don't believe it, but data in Scotland shows that from February 2008, the unemployment rate has fallen. Right? Makes no sense. And so it's just actually what goes on in the labor market is very different from what the labor market data tells you, because it wasn't designed for a shock like this.
Okay, so we have a couple of charts up here of recent papers that you've talked about. You want to go in and tell us?
So I've been working a lot on trying to understand where the economy is and what's going on. So this is the labor market report you referred to on last week, which is the one that was a bit of a shock. And I should be mindful that several bank presidents who really should keep quiet have really said ridiculously stupid things. One of them said,
the hawks?
Well, yes. So one of them said, if the labor market releases are strong, that's a really strong reason why we should start to taper and start to think about raising rates. So now you have a weak one. He hasn't come up and said, oh, well, actually, there's a reason not to now. So the first thing is these reports are going to be volatile, and it's not clear where they're going to go. So this was a surprise to the downside. And this is, let's look at employment, where we are in employment terms. So on the right-hand chart, that's non-farm payroll employment today compared to where we were in February 20. And as you can see we're still, 5 million or so under where we were before. the unemployment rate itself is also well above where it was. So we're still in an adjustment path. And I'm just going to take us to the big number. This is taken from the BLS. This is the actual EMPSIT, they call it, the Employment Situation Report. Okay. And this, to some people, was a surprise. And here, in a way, Dale, is the big shock. Still, we are still seeing this shock to retail trade. And so we still have a negative number in retail trade. There is some of the thing is that government now seems to be pretty flat, because one of the big things has been government too. But this was a pretty small change in employment. But you have another number which people didn't focus on, whether this is a big indicator or not. Let's just look here. One of the big indicators, it turns out, of what's happening to an economy is to go look at marginal workers. So think about, who are the ones who's the data we should look at? Last in, first out. If you're not hiring, who gets impacted? So the worry was actually teenage unemployment jumped by 1.6 percentage points on the month. Now that may just be a volatile series, but if you see an economy slowing, what do you see? Which groups do you see impacting first? Now, we've seen a big decline in Black unemployment, Asian unemployment. But look, Black unemployment rose too. So Asian unemployment goes down, but Black and young unemployment rises. So that would be something that I would be very concerned about and watching going forward. So the marginal workers, and what is interesting that people need to focus on is that when you go to non-farm payrolls, the coverage from the establishment data is narrower than the coverage from the household data. So the household data is the CPS, current population survey. But you get in there people who are not working for firms, so the self-employed, household workers, marginal workers. So watchers of this, listeners to this podcast, or watchers of what we're talking about, should actually focus at these turns on the household survey. Now, this household survey number was pretty good. You got a plus 509, but the place where you're going to see weakening coming will be first on the household account. Because think of it, very small firms are the ones impacted the most, the self-employed, people who work, gardeners, home helps, all of that. They're the ones that give you the most signal. So
retail
I was
trade. I just want to circle back to retail trade.
Yeah, sure.
Would that have anything to do with supply constraints?
Well, I think it's that, but I think it's also COVID, right? I mean, so what's happening in places in the South is you see a rise in COVID, you see a rise in COVID cases. People stop going to restaurants. That's one of the, so that's the, I mean, these are the things that labor economists should sort of teach people. Where's the sectors that you're going to see most volatility in? Where are the job opening opportunities? Where are they going? Where are they coming from? So obviously healthcare, retail trade are sectors that we need to worry about. Look here, there's the 4.6. So healthcare and social assistance down on the month. Those I think are the places that we should look at. So I think this was a worrying month. The way that I would think about it would be, so let's look for the next month. Let's see if it, 1 month doesn't make a trend.
Exactly.
2 or 3 might. And so it takes you back to I think the various bank presidents, as far as I can tell, are completely asinine. The right thing to say as a policymaker is the following. We don't know what's coming. We don't know what's going to happen to the vaccine and the virus. We don't know what long-run changes in behavior are, and we don't know what fiscal and monetary authorities are going to do. So we're going to sit and we're going to wait, and the right response depends upon a variety of scenarios.
Let me cut in there. Does the infrastructure bill, in light of your data, become that much more important for longer-term labor growth? At least the first part of it. Not the 3.7.
I mean, I'm not, it's hard to say whether 3.7 or 4.2 is the right.
Yeah.
That's going to be a political issue.
It sounds like real money.
Oh, it sounds eventually. Well, I voted.
Oh, no, it's $1. So
I voted the first time. I think I voted for £100 billion of QE. Right.
Okay.
And I thought that's quite a lot of money. That's really quite a lot of money. And then I realized after a while it wasn't, because then all of a sudden you had zeros put on the end of that. But I think I voted in the end for 250 billion pounds worth of QE. Not many people can say they did that, but drop in a bucket, right? Anyway, no. I mean,
nowadays,
infrastructure bill. I mean,
now it's the T word instead of the B word.
Once you move from B to T. Can I tell you a little story? So we were trying to work out. We were sitting at the Bank of England, and we were trying to work out how to scale QE. This is literally true. So we said to the staff, "What we're going to do QE, but what's the unit of observation here? What's QE equivalent of 25 basis point change in interest rate? What's that equivalent to?" So somebody said, "Well, what's like 1% of GDP?" So we said, "No idea." So we said to the staff, "Go out and get 9 pieces of paper. And on those pieces of paper, write down, don't say it in billions, write down the actual number," right? So we could actually look at it and go, okay, so 1% of it is, so we literally tried to think, well, what's 1% of GDP, and scale it like that. But literally that was fumbling around in the dark. But anyway, but the point of your infrastructure story is that it seems to me, and I think this is right, that essentially, and if you go back to Keynes, the mistakes in a pandemic and a shock is to do too little, right? So think of that hurricane comes, hits southeast Florida, wipes out Miami. What do? And the banks fail. What you should have done is the central bank should have gone and prevent the banks from failing and put in a big infrastructure, and that would have prevented the great crash. So what we learn here is more is better. The risks are still to the downside. And what you need to do is you need to allow the economy to adjust from a giant shock. The chances that the inflation numbers are permanent is zero. The hawks are at it again. Nonsense. The argument here is the story will always be too little is the issue. And obviously then we can argue about, if you're going to do something, what should you do about it? Where should it be? It clearly should be an investment in infrastructure and not in consumption. But the bottom line is still the risks are to the downside. That the economy will slow, and that as in 2009-10, too little will be done. In the UK, as in 2010, they went to austerity. They're going to austerity now, same mistake again. And
let me ask you this, that's too little. And this is your wheelhouse, having been a central banker. Why is what we're hearing is that there's too much liquidity, and that's why the Fed is doing reverse repos, record amounts of reverse repos. Can you explain that to me? I never knew there was that too much liquidity could be a negative event. So why are they doing this, Danny?
Well, I think the answer is that go to the macro textbooks, right? If you went back to the world, think about quadrants. You draw 4 quadrants, and everything's drawn in the positive quadrant, right?
Yeah.
Nobody ever had a textbook where the nominal interest rate was negative, right?
Okay.
Nobody ever considered the fact that we would be near at the zero lower bound. So when you get, and we realize that zero is not the lower bound, right? It's the number below it. And so the problem is that once you're there, the risks of deflation are worrying. You don't know what to do about it. And so the limits of what central banks can do are substantial. Presumably, this is not something they set out to do. It wasn't sort of a policy that the Fed decided, I would like to see this reverse repo thing.
Yeah, so it was a side effect. Side effect of the medicine.
And the problem, in a way, that the Fed faces, which we can talk about, and I've talked to Ben Bernanke about it. The problem the Fed faces is what if it's got interest rates? Well, they're off the table. So what can it do in QE? It can buy treasuries or mortgage-backed securities. It's limited by what it can buy that other central banks in the world are not. And so if left to its druthers, the Fed would not be doing the behavior that it's doing, but it's limited by what the Congress can do. Think about what the ECB talked today about doing some sort of tapering, seeing some growth in the economy. And that's had a real effect on markets this morning, because presumably the only question is when Christine Lagarde has to reverse that. And obviously what we've seen around the world in Japan, and I mean, when I was at the bank, I actually voted to buy private corporation bonds. So I think it's the limit when you're at the zero lower bound. It's the
Okay, well,
consequence of flooding the. I mean, because you can't cut interest rates enough, so you're desperately trying to find ways to stimulate things. The answer is, of course, go back to your original question. If the fiscal authorities are doing masses of infrastructure spend, that takes the pressure off the central bank, and it doesn't have to keep doing this stuff with the consequences that it has. And go back to another consequence. If you purchase assets, that raises the wealth and the well-being of asset holders against people who are not asset holders. So that has an effect on inequality. Whether you want it or whether you don't, it does. And so the balance then is, because the fiscal authorities pull back, all the weight is on the monetary policy side. Now, when you start to see a rise in infrastructure, that might give the Fed some room to actually taper and to, in fact, raise rates later, because they're not the only show in town. So I think it's a great answer. Hopefully it's a good answer to your question.
It is.
But I mean, think of 2010 and the Bank of England sees the fiscal authorities cutting public spending like no tomorrow. What's the option? You should raise rates. Oh, give me a break. They have no choice. And so this perhaps gives the Fed some room if this big infrastructure thing goes in, and if it's too much, whatever that might mean, that does give the monetary policy authorities room to cut QE, to taper, and in the end, raise rates a bit and try to get us back to normal. But it's the balance between monetary and fiscal policy.
Isn't there also a possibility of rates going more negative yield? What are we?
Yes.
We're about what, 2%, negative 2% real yield, and in World War II, we went to negative 13, 14%. How did they do that back then?
I'm not an expert on that, right? I mean, I always thought, I remember having meetings at the Bank of England, and they told us that. I kept saying, how low can we go? And they told us you can only go to 0.5, because if you go to below 0.5, that'll wipe out the building societies. Well, it turns, couldn't you just change the law? So they changed the law, and they told us that, they kept saying you can't go low. Well, they go to 0.1, and then you say, well, so here's the thing I always have in my head. How is 0.1 different from minus 0.1? I mean, I get that 0.1 might be different from minus 13. But, right? I mean, if you think, well, you're at 0.1, why does a little tiny move, let's say you cut by 0.2?
Yeah.
You know, so I don't know whether we believe that there really is there is no such thing as a zero lower bound. We know that. So the issue is, how low can you go? And you're probably more an expert than I am, but
I think that was it.
I think that was it. And the answer, of course, is companies like Apple. You go to cash. Where are you going to put the cash? You know, the central bank is a place to put
financial engineering, dividends.
Yeah, exactly. But still,
and then, or the airlines did the same thing. And then when COVID hit, they had no rainy day fund, and they
had no rainy day
hand in hand.
Exactly.
Yeah.
And so, but go back to your earlier point. Where does adjustment come from? What do firms learn? What have firms learned about? I mean, what have people learned about rainy day funds, right? If you go back to think about you and I have had these conversations over time. Yes, the consumer is king. But when a shock comes, what does economists say? Economists say, well, a shock ought to show people that they should do precautionary saving, that they should build up their buffer stocks, and they shouldn't consume. And what do? They say, screw that, we're going to consume like crazy. So the question in this one is this the one? Is this the one that make people, because people have saved a lot, right? They didn't spend things. They weren't going out.
They were paid down debt.
They paid down debt, but are they actually going to go and consume again? And if they're not, that's a significant downside risk to output, right? And to companies and profits and so on. And the question is, we've been wrong every time, but at some point you might think a giant shock like this might suddenly change the savings rate.
Okay.
And it might change what you talked about is how it changes things for companies. Companies realize that they need rainy day funds. They don't need to distribute it as dividends. They need to perhaps have buffers. And that might be the conversation going forward we're going to have.
Okay, Danny, another great talk. I'm wondering if you want to wrap it up with something, but my encapsulation of what you said today is that things are not improving, that we have a long way to go to making these adjustments. This was a once in 100-year phenomena or shock, and there probably aren't a lot of game plans or battle plans for how you handle a pandemic in the modern age. And
and I think I'm happy to wrap up, and I think I'm going to lead into a conversation I think you and I are going to have again at another date, which is that the labor market appears to be central. So if you go back to 2008 and the Great Recession, it turns out that the NBR dating committee dated the recession in the United States to December 2007, based essentially on the labor market. If you just use the 2 consecutive quarters of negative growth, that gets you the third quarter of 2008 in the United States, if you use that. If you take the NBR thing, it gets you to December 2007. And actually, I was saying to you earlier, it turns out that by August 2007, based upon, if you just look at employment change across states, 38 states by August 2007 had entered recession, right? So the labor market turned out to be crucial going in. You can look at SARM rules and all sorts of other things. But in the United States, that was crucial. In the pandemic, the big response was in the labor market. So wait and watch, but also understand how hard it is to measure things. So let's just finish with this. So not only in April 2020 did we see a rise in the unemployment rate from 3.5% to 20%, but we saw a rise in wage growth from 3% to 8%. From 3% to 8%. Every recession we've ever seen around the world, as the unemployment rate rises, wage growth falls. In the United States and other countries around the world, wage growth rose. So this is a big issue. Why is that happening? I mean, you finish on an issue in the UK, show how hard this is. In the UK, there's a thing called the triple lock. And the triple lock is how you raise pensions over the next 12 months. And it's 3 parts. The first is 2.5%, is the max of any of these 3. 2.5%, the CPI in June of that year, or average weekly earnings in June of that year. They have a problem, which is that average weekly earnings in June 2021 were 8.8%. So now they have an issue, which is, oh, shoot, are we going to use the triple lock rule and give them an 8.8% pay raise? But actually, wages aren't really rising by 8.8%. So now we're in trouble, right? So there's a good example. So you promised you're going to use the triple lock. But if you use the triple lock, it's going to cost you, $50 billion more than you thought. And if you don't do it, you break a promise. And what is going on in the labor market? Are wages really rising by 8.8%? Well, of course they're not, but that's got you in a pickle. So I like labor market pickles, and that's what you and I are going to talk about.
Okay, well, I like Clausen pickles.
Exactly.
there's a lot of garlic.
These are labor market pickles.
It keeps the market vampires away from me, Danny.
Exactly.
Anyway, Danny, go ahead. Really a pleasure again speaking to you. I learn every time you and I have a discussion, and really these are confusing times. Maybe our leaders have to learn to say we don't know. And
we don't know. And the right thing, Dale,
people have a hard time saying I don't know.
Forecasting, Dale. The right way to say it is I don't know, and it depends. And here are 5 different scenarios. I don't know
on one hand, and on the other hand, and on the left leg, right leg.
So it used to be on the one hand, on the other hand.
Right.
Now we've got one hand, another hand,
a few fingers,
an arm, an elbow, hand.
Yeah. So I mean, keep it vague because it's unprecedented. Instead of thinking that and boxing yourself in like
saying stupid stuff. We've got to avoid saying stupid stuff. And I'm shocked by how many, particularly Fed bank presidents, have not understood that.
Yeah, that we have to taper right now. Kaplan. Okay. So anyway, thank you so much. Really appreciate being with you, Danny, and you filling us in. And, it's a new one for me to be looking at labor markets for turning points in the economy, which then leads to turning points in the markets. So
go back. The labor market was where you should have been looking to get the turn.
Right. The turns happen in labor.
Correct.
Danny Blanchflower.
Yes, sir.
All right. All right. So that's a wrap, everyone. I hope you enjoyed. Danny, you could follow him on Twitter at D_Blanchflower and go to his website and keep up with what's happening in labor. You have really a scholar to fill you in and in language that guys like even me can understand. So I appreciate it very much, Danny. Have a great weekend, and we're going to do this again.
Yes, sir.
A month or so down the road, okay?
Yes, sir. Bye.
All right, that's a wrap, everyone. Remember, don't just count your pips or your employment applications, count your blessings, and we'll see everyone tomorrow.